From the morning reading, the Qs, the spiders, new all-time closing highs as advancers and breadth expand. Many of the important companies come in with very positive earnings per shares reactions. Breadth strengthened compared to the prior session as advancers led 22.34 to 793 on the New York Stock Exchange and 2023 to 772 on the NASDAQ. On the S&P 500 snapshot, record intraday high and record close. The S&P 500 continued the upward trend that began early Monday afternoon, moving in a remarkably smooth upward direction to its 0.86% record intraday high. Some profit taking in the final hour trimmed the gain to 0.66%, a new record close. Like the S&P 500, the NASDAQ also hit intraday and closing record highs. Stocks finally broke out. Tuesday's move to a new all-time high in the S&P 500 was not exactly decisive, but it was still a new high. The breakout came on the heels of what had been an extremely tight consolidation, setting up the textbook bullish pattern. But we know that the textbooks are better at theory than practice, and even during this remarkable bull market, similar breakouts from consolidations led to drawdowns of 3% or more every single time. The breakout ended what had been a creeper uptrend. The S&P hadn't strayed more than 1.5% from its all-time high for more than 2 months. That happened last year also, but the streak ended with a loss, this time a breakout. Other times that such long streaks ended with a breakout to new highs, future returns were muted. This was stock's new high in 2 weeks. New all-time highs get a lot of folks excited, but they get excited about what already happened and not what's likely to happen. When the S&P 500 sets a new all-time high for the first time in weeks, its future returns tend to be well below average. Nearly 50% of our indicators are once again showing excessive optimism. Since 2010, there have been 55 days showing 40% or more indicators above their optimistic thresholds. The S&P 500 showed positive return 3 weeks later, 21 times for a 38% win rate, with an average return of a negative 0.5%, risk of a negative 2.1%, and reward of a plus 1.1%. In other news, material spider hits a new high. Leaders are Century Aluminum, Freeport-McMoRan, International Paper, and Dow Chemical. D.R. Horton leads the home builders higher. Consumer discretionary spider reaches new high. The S&P 500 is close at the time of this writing. Russell 2000 iShares finding support at the 50-day line. Market uptrend remains intact. Okay, I think that's probably enough for the morning reading. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 5:45 a.m. Mountain Time, and I'm recording this in preparation for the market day of January the 25th, 2017. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and dive into the morning report. And at the time of this cut, we got some bullishness moving as continuation and confirmation of yesterday's action. The S&P futures are up about 7.5 points, or about 1/3%. Russell futures are up almost 0.5%. NASDAQ is up almost 0.5%. The Dow futures are up over 1/3%. Crude oil is down about 1%. Euro's up about 1/3%. Long bonds are scratch. And gold is down about 0.4%. In overseas action, it looks like all of our key markets are open. China up about 0.25%. Hong Kong up about 0.4%. Japan up 1.4%. Germany up 1.3%. United Kingdom up about 0.25%. In macroeconomic reports for the United States for today of note, you have the crude oil inventory weekly report. And looking forward to tomorrow, key U.S. reports include the weekly unemployment claims, new home sales, nat gas storage, and that appears to be about it. In terms of current volatility conditions, as you would expect, things calmed down with yesterday's bullish action. Short-term VIX down to a 10.08. Skew still elevated at a 138, but now down off of its highs of recent action. IV percentiles for the four markets are all practically in single digits. The S&P at a 9, the Russell, the lone two-digit at a 10, the NASDAQ at a 5, and the Dow at an 8. We did have standard deviation size moves across all four markets yesterday, with the S&P, the NASDAQ, and the Dow all at more than one standard deviation on a close-to-close basis, with the Russell coming in with a 2 standard deviation size move. So pretty significant activity yesterday with large moves, and also at the same time new record highs on 2 of these 4 markets. Let's go ahead and go to the charts. And you'll recall yesterday that we talked about this short-term triangle and that there was about a 70% probability that it would break to the upside. And if it did explore this area to the downside with the remaining 1/3 probabilities, there was a lot of support in here. And while there was some room that, you know, it could play in here, it was pretty unlikely. And indeed, can't really tell you just exactly why it did it yesterday, other than I saw some chatter about you know, the various Trump administration announcements being seen as pro-business and pro-economy, and you know, there was talk of infrastructure, there was, you know, a number of different things, pipeline construction, etc., all of which would be, of course, very good for the economy in terms of hiring and you know, opportunities for new jobs, and not just service sector jobs, but in many cases some well-paying jobs. So that was seen as quite positive, probably indeed the likely reason for the breakout. And you had not just the diagonal breakout from the triangle pattern, but you also ended up with a horizontal breakout as well. Now the actual close came in right at the prior intraday highs, but it was a new closing high as well. So really quite bullish. And then today, so far, we still have yet to have the cash market participants come in, but so far we seem to be having a confirmation move on this. So where is this likely to get to? Well, you've seen us already talk about this rising channel, as it were. It's not really a channel, it's more of a wedge, but it's a big broad channel in effect, and we're probably heading right up here to about a round number around 2,300 or so. So it would seem like the upside potential here is about 20 points further or so. We also talked about this yesterday, that if we did get the breakout, part of what you'd have to deal with is that there probably would not be much of a new leg. And this has been the history. 2 months ago, when we had the last new high of significance on the post-election rally, that was an incremental new high over the prior high. And we continue to see this pattern in the last 2 years, where we'll go at times months in between new highs, but then the new highs are incremental new highs. And certainly some of the stats that you were given from one of the morning reading authors indicated that if we have further continuation on this, it's likely to be a relatively muted move before we see more sideways consolidation. So that's the pattern we've been dealing with. And indeed, often after these new highs, 3 weeks later, there's often about a 2-to-1 odds that price is lower. So it's very difficult to be piling on lots of new positions at this point. Be very careful and very selective about what you add at these kinds of levels. So The bulls continue to control, and we'll look at the daily report for more evidence of that. And yet, at the same time, it continues to be something of a difficult market for just outright bullish swing trades, in that we get these incremental new highs in between long periods of sideways consolidation. And the other market that was so strong yesterday, we have to give it to the NASDAQ. Now, we continue to watch where there's opportunity, and we discussed this yesterday as well. When you look at the big five, 4 of the big 5 had room to run just to get back to their own individual 52-week highs or all-time highs. So that would seem to say that there's room for the NASDAQ to continue on its building. Breadth has not been great on the NASDAQ, though certainly improved yesterday. We'll probably continue to see more bullishness in the NASDAQ sector, more opportunity in the NASDAQ group than we do in the S&P or Dow. So certainly very, very bullish there. We'll take a look at the Dow now. And the Dow, of course, did not have a new high yesterday, but basically came from, in recent sessions near the bottom of its action and something of a little bit of a bearish drift, and certainly has turned that around and is currently trading right at the intraday high. And in fact, we were really, really close, just a few ticks away from a new intraday high on the Dow. And of course, if that were to build, we could indeed have the Dow join the NASDAQ and the S&P with new all-time highs in the last session or two. And the Russell also was relatively weaker going into these recent moves, and has, with the result of these, kind of inflected off the bottom of that range and come back up. At this point, we're more like halfway through its recent trading range, so it's got some work to do and has some room to run before it even gets back to its more recent 52-week high and all-time high that was made back in the middle of December. Okay, let's take a look at some of the other markets. Crude oil continues its sideways consolidation. Lots of movement, but nothing achieved in the crude oil daily charts. And gold seems to have finally run into some significant resistance. We talked about as it came into the cloud that its posture had basically gone neutral. And you see here, for whatever reason, this 1219 area is acting as pretty significant resistance, with now about 4 touches in recent trading sessions of that area and rejection off of that area each time. So it's going to be very interesting to see if indeed we finally power through this, or if this is the end of the counter trend move and we get a resumption of the primary bearish trend before coming into this recent action in recent weeks. And bonds, of course, had already shown some of that action. It ran into its own resistance a little earlier and repeatedly pounded up against this area, and then has fallen down and away from that area at this point. So we'll continue to watch and see how these two markets develop, and then of course how the dollar is influencing them. Now, the weaker dollar certainly has been a part of this, and notice that the dollar, after having been strong, very strong, for several months, has now fallen into its own neutral posture. It's in the cloud. And if we were to get a breakdown below the cloud, that would be a Chicow and, well, it'd be a cloud breakout initially, and that would certainly be a bearish signal for sure. So the dollar may be on a bit of a rotation retracement back from its recent all-time high strength. I said all-time high. It's actually about a 14-year high on the dollar. And then let's take a look at volatility. Volatility just about, well, look at this. we are at a 52-week low on volatility. It not only is below the 12 handle, it's below the 10 handle, below the 11 handle. It is now registering currently at a 10.61, was the intraday low a little bit ago. So very, very, very low volatility conditions, and this definitely has an impact on what we do in some of our trading. We'll talk about our strategies in just a moment. In terms of the daily report, this intermediate term phase opinion, we're probably on the verge of flipping back into phase 3, which is bullish, and that's where you look for bull flags and bullish continuation patterns. We've been oscillating. We didn't quite get that signal, but we've been oscillating between 3 and 5 in recent weeks and not going very far with either one of them. So we're going to just call this a very neutral kind of setting, but perhaps improving setting at this point. In terms of the 3 market timing signals, and all 3 of these, of course, are mechanical in nature from 3 different looks at the market, 3 different perspectives. The first one coming to us from IBD, confirmed uptrend. That one is bullish. GMI index is the second one. It actually improved to a 6 out of 6, and that buy signal has been in place since 11:10. The GMI 2, which is a more sensitive indicator, is at a 7 out of 8. In terms of the decision points scoreboard, that one coming to us from stock charts has not changed yet. I would expect that these short-term signals will start popping into more consistently bull status if we see any kind of continuation follow through at all on this price action of late. Now, right now though, what we have is mixed signals on the short term and mixed signals on the long term. Overall consensus bias between the 3 signals is for a bullish market, but one with likely relatively muted both bullish and bearish moves. Portfolio position sizing opinions and active trader position sizing opinion both coming in at 100%. Intermediate term market posture, we've seen an improvement here with first day signals on both the Dow and the Russell flipping back to bull side. The S&P managed to hold on to its exceptionally strong bull throughout all the consolidation, albeit it started crawling down towards the threshold, but never ever actually crossed it, still holding on exceptionally strong bull. Dow now strong bull, NASDAQ exceptionally strong bull and up over 90 for the most powerful reading, and the Russell is a weak bull with yesterday's action, though yesterday's action certainly was strong. It was a 2 standard deviation size move, but we always are somewhat a bit of an asterisk on these things at the first day signal. We sometimes see first day signals deteriorate and flip back the other way, so kind of take that with a little bit of a tongue-in-cheek approach at this point. But still, overall, all these indicators are on the bullish side, and we just certainly would not expect an awful lot of bearish risk to the market based on the information that is available at this time. Hedge warning status is 0+, normal with some elevated conditions. And I made reference to this a moment ago. In terms of the strategy opinions, the option income strategies, we've been talking about how the VIX has been flipping back and forth between above 12 and below 12, and how when it's below a 12, it's somewhat challenging environment for novice traders to be doing option income strategies, and that the premium received is so low relative to the amount of risk that is being taken on. Well, this certainly is true now when we're playing in the 10 handle. Very, very low premiums. In fact, on the flip side, it's probably a much better opportunity to be buying that long-term protection or to be setting up that intermediate term volatility trades to where, you know, at some point, obviously volatility will expand, and this is probably a wonderful opportunity to be able to buy into some of that protection or hedging tactics at very, very good prices. Basically, you have a clearance sale on volatility trading setups at this point. Very good pricing. It's not going to get much cheaper than it is right now. The only question is how much time do you need for a volatility expansion to occur? And usually that's longer than you think it is, so just kind of keep that in mind. In terms of the other two strategies, everything's fine in terms of the opinion to initiate new positions. The only caveats being, as you heard from one of the morning reading authors, that in these kinds of environments, we've not actually had lots of opportunity for continued follow through to the bullish side. And in terms of short term, say 3-week returns, those have actually been poor after these kinds of new highs. So just if you're adding more delta positions to your trading or investment portfolio, be very selective at these high levels and kind of continue to build, and while at the same time, in covered call strategies, for example, building those positions with a ratio of out of the money and in the money strikes using a 1-to-1 ratio of high beta and low beta is certainly probably going to be a great approach to take if you look around 4 weeks later and you find that the only reason you made money on that covered call was because you sold premium and not that the stocks have really done anything significant for you in many cases. That certainly has been true of many of the outcomes of covered calls in the last year. When I look at my own trading log results, much of the profits, while it's had a very, very high win rate, much of the profits have come from the selling of premium, not so much from the capital appreciation of the stocks themselves. So taking these kind of conservative approaches has been the best way to make money in the current environment. Put selling, certainly it's a good market for put selling whenever you get a pullback opportunity. We had one of those in recent sessions. We did a little bit of this, and being able to take advantage of any pullbacks that you get, especially in those good classic watch list charts that you are building. This is a good market to be doing put selling in general. In terms of specific areas of warning, most of this is related to low volatility conditions and the expectation of volatility expansion at some point. You do have this high skew, so that means that things are kind of mispriced on the outer edges versus the inner areas. Distribution day count on the NASDAQ continues to persist in elevated areas. In the trend-based area, mostly bullish signals. We got this market phase probably waffling between a 5 and a 3 at this point. But the New York Stock Exchange yesterday, new highs, new lows, almost 500 on the bull side. So very strong performance put in there. Key intermarket risk aversion indicators, all 5 are still risk off. We're seeing some wobbling back and forth. In one moment you think maybe they're rolling up and then they go back down. It's right now, they're all 5 risk off, and we'll just kind of leave it there until we get a clear crossover. From a sentiment standpoint, relatively benign on all 4 markets, and you see the fear and greed index coming in at a 54 in a neutral status itself. From a sector specific, big performance yesterday, of course, almost across all sectors. The only real exception, healthcare, and we continue to kind of point at the weakness of healthcare. Very difficult to be successful in investing or trading in healthcare to the bull side in recent weeks and months, and this continues even on days where broad markets are making new all-time highs. Also, telecom with AT&T and Verizon on the negative side. Other than that, broad participation on the especially risk-on sectors. You see the other more defensive groups here, utilities and real estate joining telecom, and then consumer staples, in the lower levels of performance of the trading yesterday. Sector specific market postures by the multiple time frames. You continue to see some separation here, and the most consistent performers continue to generally be the consumer sectors, joined by transportation, financials, industrials, and materials and technology. I draw special note to materials. D.R. Horton, the home builders, one of the morning authors, mentioned that. Big move yesterday. Technology has been probably our most consistent area of late. So kind of keep in mind that. And then also on the flip side, where's the weakness? Again, healthcare and retail. Very, very relatively poor performance is being put in by those sectors and industry groups. And with the action yesterday, you see a lot more green across the different time frames, but also still note that the 1 month performance, was starting to see some more separation. We had a period there where there was hardly anything more than plus or minus 2%. We're starting to see a bit more separation. You got materials, we just mentioned that, information technology, and consumer discretionary. So more risk on kind of better performance in the 1 month time frame. And perhaps the odd one out there is real estate, coming in at 2.32% over the last month. Telecom, worst. And then also energy and financials, doing some retracement of late. Okay, I think that's enough. We're certainly very long today. So a lot of neat stuff happening with recent trading the last couple sessions. So that's where we are. Let's go ahead and wrap this thing up. Disclaimers, as always, hit the pause button if you need more time to read the disclaimers. Also note the hyperlink down here at the bottom for the full set of disclosures. And we'll be back here next for tomorrow's market preview from Falcon Global. In the meantime, as always, manage that risk profile and seek to go out there and learn something about your trading and investing each and every trading day, and your performance will certainly be far more consistent. Good trading.